Welcome to the next blog to video installment, Trading Losses, How Much is Too Much? Thanks for tuning in and joining us for this important detail in your trading career. If you'd like to read the blog, you can find it on our website. Let's begin. Losses are a part of trading. Even the best traders who are considered elite level will experience losses at some point. By the way, an elite level trader generally realizes a consistent 25% annual return on investment. There are many factors why traders lose money. Most of them can be found in two categories, or pillars: trading psychology, the largest part of your trading, and money management, which is a close second. Granted, technical trading mistakes may be responsible, but with more reliable indicators and visually identifiable signals, the technical pillar of trading generally falls to a distant third. The occasional loss shouldn't really impact your account greatly, but if your risk profile is well structured. While this particular blog is not specifically about risk, the fact is that many losing traders really don't have a system that takes risk into account. Where loss can become a significant concern generally occurs when traders either ignore risk, over-leverage their trades, or suffer a losing streak, usually more than 3 successive losses in a row. Traders sometimes retaliate against the market by taking on larger size trades, doubling down, also called martingale, ignoring limits and stop losses, or engaging in other reckless behavior to return their account value back to prior levels. These reactions can quickly become the onset of a quick death spiral to blowing up your account. Ironically, the worst thing that can happen for the long game is that you guess correctly and make your money back in one lucky trade. So, why is a lucky win a bad thing? Mentally speaking, a lucky trade now creates an acceptable condition where no matter how much you may lose, you believe you can gamble your whole account and recover. This is a terrible idea and will create bad habits, ultimately dragging your account down to zero. Simple advice: don't do it. So, what do losses look like as a percentage of your account? And what do you need to get it back to where you started before the loss? Here is a breakdown by percentages. As you can see, it starts off fairly harmless. Lose a percentage or two of your account, and it's not that big of a deal to get it back. But you'll notice that once it eclipses 10%, things begin to get a little scary. Coincidentally, we advocate in the advanced course that you do whatever it takes to stay below a 10% drawdown, as noted in the course module. If you find that you're hovering around that loss level, the smartest thing you can do is stop money trading and go back to demo or paper trading to figure out why your system is not working. Ultimately, some people do lose a majority of their account. That creates a lot of systemic issues, and not only to your bottom line. Psychologically speaking, it will place your mind in a dark place. People react differently here. Some folks will gamble their account, give up and try their hand at investing in stocks, crypto, etc., regroup and figure out what went wrong, continue as though nothing happened and lose everything, or abandon their system and look for a holy grail devised by somebody else. At the end of the day, only you can make the decision of what to do. What we suggest is this. First thing, immediately stop trading with real money. Take a small break away from the charts. Clear your mind and give yourself a pardon from the noise of the market. Go back to your losing trades and your journal. You have one, right? And analyze why those trades booked a loss. Once you see where and why your trades failed, work towards fixing the issues by finding better indicators or changing settings. Backtest your improved system to verify that it works in hindsight. Be sure to test it against the 5 currency pairs I discussed in the Schaff Trend Cycle Indicator blog. Forward test your system on paper until you are absolutely sure it meets with your expectation with respect to returns, and then, and only then, resume trading with real funds. Be sure to sign up for our email digest to receive advanced notification as we continue to publish relevant Forex material that you can actually use in your everyday trading. If you're new to our channel, be sure to hit the subscribe button to be notified each time we post a new video blog and give us a like. Of course, Come see us at www.stonehillforex.com and explore our website. We're also on Facebook, so be sure to like us to get notified of new posts. Discover a world of Forex information all in one place. Our only goal is to make you a profitable trader.
Any information communicated by Stonehill Forex Limited is solely for educational purposes. The information contained within the courses and on the website neither constitutes investment advice nor a general recommendation on investments. It is not intended to be and should not be interpreted as investment advice or a general recommendation on investment. Any person who places trades, orders or makes other types of trades and investments etc. is responsible for their own investment decisions and does so at their own risk. It is recommended that any person taking investment decisions consults with an independent financial advisor. Stonehill Forex Limited training courses and blogs are for educational purposes only, not a financial advisory service, and does not give financial advice or make general recommendations on investment.